Warren Buffett's annual letters are, of course, legendary. But the 1990 letter to shareholders, it's something else entirely. It's not a history lesson. It's more like a living, breathing, operating manual for any serious investor. So let's just jump right in and pull out the timeless principles that are just as powerful today as they were over 3 decades ago. So first, let's just start with the big headline number. From 1965 all the way to 1990, Berkshire Hathaway's per-share book value grew at a compounded annual rate of 23.2%. I mean, that is just a staggering world-class performance over 26 years. It's a kind of track record that builds empires. But what's really fascinating is how Buffett himself saw it. Right. Despite that incredible long-term record, Buffett called the 7.3% gain in 1990 lackluster. And look, this isn't some kind of false modesty. This is a masterclass in what really matters. He's telling us that the headline numbers, even the really, really good ones, they aren't the whole story. He's judging his own performance against a much higher, much more meaningful standard. And that, right there, raises the central question for this whole explainer. If a track record that most people would kill for is just sort of background noise, what is the metric that truly matters to Warren Buffett? What is he actually looking at? Well, let's find out. Okay, so the very first principle is this. You have to learn to look straight through the official numbers. Standard accounting, GAAP, it's just a starting point. To really understand a business, you have to see its true economic reality, not just what's on the official report. And here's exactly why. Buffett does not pull any punches with this quote. He's warning us that reported earnings can be manipulated, they can be twisted. For him, those accounting numbers are just the beginning of the conversation, not the end. The real work is figuring out the true economic earnings that are actually flowing to you as an owner. And to do that, he uses this concept he calls look-through earnings. Now, this is absolutely fundamental. It accounts for Berkshire's slice of the retained earnings from the companies it partly owns. Think Coca-Cola or Capital Cities back then. These are real profits that are working for Berkshire, even if they never, ever show up on its own income statement. And the calculation he laid out is actually surprisingly simple. He just starts with Berkshire's share of its investees' retained earnings. Then he subtracts the taxes they'd owe if those earnings were paid out as a dividend. And then he just adds that net number right back to Berkshire's own reported operating earnings. And the impact, it's just staggering. In 1990, this one little adjustment transformed $371 million in reported earnings into $590 million in look-through earnings. That's a 59% jump. And this isn't an accounting trick, right? It's just a clearer view of the actual economic reality of the business. So you might be asking, where does the money to make all these massive investments come from in the first place? Well, to understand that, we've got to look at Berkshire's hidden engine, the insurance business, and the absolute magic of its float. Buffett paints this almost grimly funny picture of the broader insurance industry, where managers just mindlessly chase premium dollars, even when it's totally unprofitable. They just keep digging themselves into a deeper and deeper hole. Berkshire, as you'd probably expect, operates on a completely different planet. The key to everything is float. It's all the money collected from premiums that Berkshire gets to hold onto and invest for itself, often for years and years before it has to pay out any claims. So, in effect, it's a massive interest-free and sometimes better than interest-free loan from its policyholders. And this table right here shows just how unbelievably powerful that is. I mean, look at 1990. The U.S. government had to pay over 8% to borrow money. Meanwhile, Berkshire's cost for its float was just 1.6%. For 3 years running, their cost of capital was just a tiny fraction of the so-called risk-free rate. So here's the crucial point, the real takeaway. For the vast majority of its history up to that point, Berkshire was effectively being paid to hold other people's money, which it then got to turn around and invest for its own gain. This is the financial rocket fuel that powered the whole machine. Okay, so we know how he evaluates earnings, we know where he gets the capital, but what kind of businesses does he actually buy with that low-cost float? Let's take a look at the anatomy of a truly great business through his eyes. Check this number out. It's incredible. In 1990, Berkshire's group of wholly owned non-insurance businesses earned an after-tax return on their average equity of 51%. And get this was done with basically no debt. These are businesses in what he calls prosaic fields, candy, furniture, things like that. So let's take Nebraska Furniture Mart as an example. Their operating costs were just 15% of sales. Compare that to around 40% for their biggest public competitor at the time. You see, that's not just an advantage, it's a fortress. It lets them price below everybody else, which creates this powerful magnet for customers that their competitors simply cannot fight. That is what a durable competitive advantage looks like. So what do all these businesses have in common? Well, they're run by superstar managers, they have these deep and wide moats, they carry little to no debt, and they generate these enormous returns that they just send back to Omaha for Buffett to put to work somewhere else. Simple as that. Now we get to the real heart of the philosophy. Owning great businesses that are funded by low-cost float, that's the what. But the when and the how, well, that's all about mindset. It's about temperament over technique. This is one of the single most important lines in the entire letter, maybe in all of his letters. See, Buffett doesn't fear pessimism. He welcomes it. Why? Because pessimism is what produces the prices he wants to pay. It's optimism that breeds carelessness and leads people to pay foolish prices for businesses. And he put this philosophy directly into practice in 1990. The market was in a total panic about bank stocks, especially anything to do with West Coast real estate. So what does Buffett do? He calmly goes out and buys a nearly 10% stake in what he thought was the best-run bank out there, Wells Fargo, for less than 5 times earnings. And when the stock price fell even further after he bought, he said, "We welcomed the decline." He used the market's fear as his opportunity. And all of it, comes back to the foundational lesson he learned from his mentor, Benjamin Graham. The secret, the whole game, is margin of safety. You see, buying a wonderful business isn't enough. You have to buy it at a sensible price, a price that gives you a buffer against bad luck or just being wrong. So, how does this all come together in a way that we can actually use? Well, in the 1990 letter, Buffett lays it all out with perfect clarity. I mean, he literally gives us his acquisition checklist. And here it is. 6 simple, non-negotiable rules. He wants large businesses with a long history of high returns on equity without using a bunch of debt. Critically, the management team must already be in place. And this is a big one, the seller has to name their price. Notice what's not on the list. No turnarounds, no complex projections, no bidding wars. Just a straightforward purchase of a great business at a fair price. And that brings us right to the final thought. Just look at that list again. These rules are completely timeless. They are the absolute essence of the Buffett playbook. So as you look at the investment landscape today, just ask yourself, which of these simple, powerful rules do you see being broken most often? The answer to that question might just tell you a lot about where the biggest risks and maybe, just maybe, the best opportunities truly lie.